question from Denise. What do you think about central banks increasing policy rates as a response to rising inflation rates and not necessarily on a holistic basis? Good question. First of all, again, I see some parallels to the situation that we had in 2008, where we basically came out an economic growth period. Stock markets were rising, real estate markets were rising, and so on. And everybody was happy. Everybody made a lot of money. Times were good old days. And then inflation increased, and same situation there. The central bank, the Fed, raised the interest rates to fight inflation, or as a response to increasing inflation rates. And that then caused a lot of default, a lot of debt, globally speaking. And to your question, I think I'm not sure if a lot of central banks or governments actually have that weapon today, right now. I mean, in theory, yes, and we're already seeing that some central banks are increasing or raising the interest rates. But I think the big problem that we have right now, or still having as a kind of inherited from the 2008 financial crisis, is that huge debt that still a lot of countries in that case accumulated during that time period, and that they didn't pay back, meaning terms like quantitative easing and so on might come into mind. Meaning, again, back in the day, the central banks basically flooded the financial markets with money, lend a lot of money to the governments, to the countries, to fight again the economic crisis and to prevent the complete financial collapse, basically. And to be honest, again, I have a background in finance and banking. I lived through that, and to be honest, from a regulatory side, from a banking side, nothing really changed. So the banks still do business like they did back in the day. That didn't really change a lot. And on the other hand, most governments or most countries didn't pay any debt, for that matter, back, or they increased it even more. I mean, we had the conversation the other day, I think, in the US, where they weren't able to repay or refinance some of their debt that they have, because they are increasing it over and over again over the last decades. So to answer your question, I think a lot of central banks do not have that instrument, or at least not the full power of that instrument, because if they would raise the interest rates, then that would also cause the raise of the bond payments that a lot of governments would have to pay, meaning the debt repayments would increase, and a lot of governments, a lot of countries still do not have the money to do so, meaning, for example, let's say, again, take Germany. Germany is able to raise money on the capital markets globally for 1%, 0%, depending on the duration that we are talking. I think it's the 10-year bond for German government is like 1%, something around that. Don't quote me on that. And just think about what would happen if we would only increase that number by 1%. Now the debt payments of the German government would be 2%, meaning it would be double the amount that it is today. And maybe a strong economy like Germany or European countries would be able to do that on a very limited scale. But I think a lot of other countries, maybe especially Caribbean countries, which are already in a lot of debt, which have already problems to get access to the capital markets and to actually raise or lend money. So I think that can be very problematic, and we will see how this is going to play out if they find the right balance, and what the next years will bring. But I have my doubts if they actually can raise interest rates without risking again the default of governments or government bonds in that scenario.